All right, welcome to the Explainer. Today we're tackling a big one, Nvidia. Look, everyone knows they're one of the most dominant companies on the planet right now. But what if that story is starting to change? We're going to dive into a pretty compelling bear case that says exactly that. Yeah, sell before it's too late. I mean, that's about as provocative as it gets, right? This comes from a recent analysis by Tony Hicks, and it is a seriously bold claim. So what's the thinking here? What's the logic behind a statement that strong? Well, let's break it down. Okay, so before we start looking for cracks in the armor, we have to talk about just how incredible this armor is. You really can't understand the bear case without first appreciating the sheer scale of this empire at its absolute peak. And wow, the scale is just mind-boggling. We're talking $44.1 billion in a single quarter. That's up nearly 70% from the year before. I mean, that's the kind of insane hypergrowth that has basically defined this entire AI boom we're living through. But you know how it is with these perfect stories. There's always a footnote. And buried deep in that same amazing report was a really critical detail, a $4.5 billion charge. Why? It's directly tied to new U.S. export rules for China. And this, right here, was maybe the first real sign that this growth engine, well, maybe it isn't completely bulletproof after all. Okay, so now we're getting to the absolute heart of the bear case. And it all starts with a really fundamental shift that's happening in the AI world. It's not about if AI is being used, but how it's being used. And that change, well, it has some massive, massive implications for a company like Nvidia. So you gotta understand that there are really two big phases of AI. Think of it like this. First, you have training. This is like sending the AI model to college. It's super intense. It's power hungry, it's expensive. But then there's inference. This is the AI model's day job. It's the everyday work of actually using the model. And when it comes to the day job, raw power isn't king anymore. You know what is? Cost, efficiency. That's the whole game. And that's exactly why this whole shift is so important. For that day-to-day inference work, the number one metric is something called total cost of ownership, or TCO. The big cloud players, we're talking the giants, are now absolutely laser-focused on one thing and one thing only: how to make every single AI query cheaper. So what happens when you're obsessed with lowering costs? Well, this relentless focus on TCO has led to a pretty dramatic plot twist. Nvidia's biggest customers are now becoming its biggest competitors. Yep, they're designing their own custom chips, built from the ground up to be perfectly optimized for their specific AI workloads, all in the name of driving down that TCO. And listen, this isn't some far-off, maybe someday kind of threat. We're talking about right now. Google, Amazon, Microsoft, Meta, the whole crew are all rolling out their own custom silicon. Then you throw a resurgent AMD into the mix, and all of a sudden, the competitive playing field looks completely different than it did even just a year or two ago. All right, so the next major risk the author points out isn't even about other companies. It's about something way more fundamental. It's about physics. And it turns out there's a hard limit here. You can't just throw an endless pile of cash at this problem and expect endless growth to come out the other side. And believe me, the money being spent is just astronomical. You've got companies like Alphabet and Meta committing tens of billions of dollars to build out their AI infrastructure. But all that money, it's starting to slam right into a very real, very solid physical wall. So what is that wall? It's power, plain and simple, electricity. Analysts are estimating that by 2030, just the AI data centers in the US will need something like 14 teragigawatts of new electricity. That is an enormous, almost unimaginable strain on the power grid. It creates bottlenecks everywhere. You can't get transformers, you can't get permits, and it just slows the whole thing down, no matter how much money you're willing to throw at it. And it's not just power. There's another physical bottleneck, this time in the supply chain. See, Nvidia has basically been eating up almost half of the entire world's supply of these super advanced chip packaging tech, all from a single company, TSMC. Now, when everything's running smoothly, that's a huge strength. But when it's all concentrated in one place, man, that creates one heck of a single point of failure. Okay, so this is where it all starts to come together. This brings us to the third big point, where the physics problem and the competition problem, they merge and they create an economic problem. The whole environment that let Nvidia command these absolutely massive profit margins, well, that's starting to change. And if you're looking for the smoking gun, the most concrete piece of evidence for this shift, look no further. Amazon Web Services, one of Nvidia's absolute biggest customers, just cut the prices on some of its GPU cloud services. And not by a little, by up to 45%. Why? Because supply is finally starting to catch up. So what does that price cut really mean? It signals the end of what the author calls scarcity rents. For the last year and a half, customers would pay pretty much anything just to get their hands on these GPUs. But now that that scarcity is starting to fade, it puts a ton of pressure on Nvidia's ability to keep up its incredible high wire act of 70+% gross margins. All right, so we've got rising competition, we've got real physical limits, and we've got fading scarcity. So how do all of these threads get tied together into a final verdict? What's the bottom line? Basically, it all boils down to these four big forces that are pushing this crazy market back towards something, well, normal. First, the buyers are getting more powerful. Second, real alternatives are finally showing up. Third, the power grid, not just customer demand, is now setting the pace of growth. And fourth, you've got regulators starting to sniff around. Now, the big takeaway here isn't that Nvidia suddenly stops being an amazing company. It's not about that at all. The point is that its valuation, its stock price, still seems to be priced for perfection, priced for a story of magic. But the market itself is shifting. It's moving away from magic and moving towards simple and a whole lot more challenging math. I mean, this quote just says it all, doesn't it? In semis, perfection is a temporary state. Gravity is permanent. It perfectly captures the core idea. The chip industry has always been cyclical. What goes flying up into the stratosphere eventually has to deal with the forces of gravity, whether that gravity comes from competition, physics, or just plain old economics. And so that really leaves us with the final, thought-provoking question from this whole analysis. When a company's story starts to shift from one of magic to one of math, is that the moment you need to reevaluate the risk? That's the question for every single investor to think about as this incredible story keeps on unfolding.